debt ceiling, taxation, spending plans, bottlenecks everywhere. Central banks are thinking about diminishing their support, as they should, post-COVID. There's a slowdown taking place in China. That is a real economic slowdown. The world is facing a whole bunch of issues.
A really big chunk of our clients said that their number one concern was inflation, followed closely by COVID recovery. But inflation is really out there.
We have a highly distorted world economy. Commodity inputs away from food and energy have surged about 40% in price over the past 12 months. What we had is industries that had shut down or are not prepared for the demand that suddenly came in. All of these types of problems, tend to resolve in months, maybe a couple quarters, not in years. So for all of these reasons, inflation will ease from those temporary bottlenecks. But the whole approach of central banks, to fight inflation in the past, but now, in fact, to boost it, is going to get us a general uptrend in the overall ambient rate of inflation.
This has been a pretty good year for families in terms of portfolio performance, and in fact, much better than last year. And we're seeing those kind of double-digit returns. And we're also seeing a reasonably optimistic outlook about things, about return profiles looking forward.
When we look at 2022, and Steve and I will be writing about this, as we think about the outlook document, what's the probability that earnings are 10% higher, in the S&P for next year? And the answer is pretty good, right? Because they've been able to pass through the labor costs, they've been able to pass through the input costs, right? And the demand on the other side continues to exist. So next year, in our view, we're going to see earnings rise and really margins stay constant, and that supports, I think, the family view here.
The environment of 2020 and 2021 is not what we're expecting going forward. 30% plunge in markets, vast buying opportunity. Now we've gained, at least at the recent peak, 30% above where we were before COVID happened.
What's really interesting to us is that people have not yet switch their view of markets to defensive shares, right? Because here, you talk about where cyclicals have done well, and that's certainly been the case and is the case right now. But what happens is that large caps typically outperform in these markets, and defensive industries better than cyclicals.
If we think about the full end of 2022, it's usually an environment where higher quality firms are the ones that haven't performed as strongly, those that are less cyclical in the healthcare sector, and in others that we'll talk about that I think are probably underperforming a bit now, like Staples, right? They haven't performed as well. But if we take a look out at their best performing firms that grow dividends routinely, the slower environment we're expecting is consistent with that type of portfolio outperforming. I think we will now, as we get into the more mature part of our financial and economic cycle, have to step back and say, what can I gain from long-term investing? The opportunities, I think, will stand out more when we're not such a wild swing type of environment as collapse and recovery.